Thank you for joining me. I'm Gord Long. A reminder before we begin, do not trade from any of these slides. They're commentary for educational and discussion purposes only. Always consult a professional financial advisor before making any investment decisions. Sentiment and investor confidence are critical pillars of the financial markets. The wealth effect encapsulates both. As markets rise, investors feel richer and better prepared and able to accept the risk inherent in financial markets. As such, their confidence grows. This well describes the stock market over the last decade as central banks injected huge amounts of liquidity into the financial system. Rising tides lift all boats. However, tides also go out. This well appears to be what near to intermediate term has in store for the markets. If this occurs, then the powerful driver, which the wealth effect has been, is highly likely to reverse and become a major drag on the markets. I therefore want to examine why this is likely to occur and what we need to pay close attention to in identifying if in fact this is occurring. As such, I'd like to cover the agenda items listed here. Markets can seem, and in fact are, irrational at times. However, markets change their behavior and perspective when the underpinnings change. The biggest such underpinning is the cyclical nature of the business cycle. We've had one of the longest uninterrupted business cycles in history since the financial crisis of 2008. Yes, it was rocky during the 2012 EU banking crisis and obviously the 2020 COVID shock, but the current business cycle was artificially and continuously extended over the last decade by these massive liquidity injections. Throughout most of the decade, this came in the form of various, and I remind you, never before used, quantitative easing or QE expansions, and in 2020, massive COVID-19 fiscal relief and monetary facilities initiatives. These continuous liquidity injections extended the business cycle by bringing future demand forward through lower financing rates and readily available credit. But what happens when we stop? For that matter, even slow. Where is the ongoing demand going to come from? To better grasp the answer, we need to understand the difference between liquidity, credit, and debt. Being very simplistic, liquidity enters the system through the monetary policies of the Federal Reserve and increasingly the fiscal deficit policies of the government. That liquidity is turned into credit through the banking system and increasingly the shadow banking system. The banking system being regulated and the shadow banking system less so. Credit, on the other hand, is turned into debt when it is actually used or in fact borrowed, the borrowers being consumers, corporations, or even in some cases by governments who must borrow in other currencies through international banks. The process is based on 1. Central banks wanting to increase liquidity into the system, 2. Banks wanting and being able to lend, and 3. Borrowers wanting and being able to borrow. But what happens when central banks want to stop increasing liquidity or in fact actually start withdrawing liquidity? What happens when banks start restricting credit because of concerns with potential non-performing loans or simply a lack of new credit-worthy lenders? Or when borrowers stop borrowing because their debt levels are such that they have insufficient collateral to borrow further or at their very limit of carrying existing debt? This is usually the situation when the cyclical business cycle starts to reverse. Well, it is a fact that the U.S. Central Reserve has not only stopped liquidity injections, but is about to start withdrawing money from the system at a rate of $90 billion per month. The lifeblood of this huge market lift we have experienced over the last decade is about to reverse for the first time. The Fed also plans to accelerate rate increases by 50 basis points at future FOMC meetings. Because of the massive amounts of liquidity injected primarily as a result of COVID-19, the Fed faces an inflation problem not experienced since the 1970s and appears to be even much more serious in comparisons. We currently have the classic situation of simply too much money chasing too few goods. As a result, there is every likelihood that the black channel shown here is about to be tested to the bottom side of it. Unfortunately, it may even be worse because liquidity is one thing, but as we've shown, credit is another. The U.S. household sector's net worth has increased by $150 trillion since 1952, $19 trillion occurring last year alone. Over the past 3 years, wealth has increased by $46 trillion or 44%. Since its pre-crisis peak in 2007, it has increased by $80 trillion. Clearly, liquidity increases have had the expected result of increasing paper wealth in America. The recent acceleration begs the obvious question of whether this is sustainable. At a 14.4% increase in 2021, this matched the highest increase in 70 years. The average of 7.1% in that period of time was less than half of last year's. Is it any wonder we now have inflation and the Federal Reserve needs to do something? The problem of banks and lenders of credit phase, however, is that household net worth is now 825% of disposable personal income. This is 23% above the Q4 2006 peak of 670, which led to the 2008 financial crisis and the U.S. mortgage debacle. Here is a clear illustration of the problem. My colleague Richard Duncan produces this, and it's what he often refers to as his credit gauge. Credit and debt are the opposite sides basically of the same coin. For lenders, credit doesn't become debt until it is borrowed. Credit growth historically must grow at 2% or more on an inflation-adjusted annual basis. If it does not, the U.S. falls into a recession. Banks, therefore, must increase their lending and borrowers must increase their debt by a 2% rate annually. With debt at 825% of disposable income, how does this increase occur? The answer, it doesn't. In fact, it shrunk last year and is likely to only get worse. Warren Buffett's famous measure to tell when stocks are too high is a similar view where he compares market capitalization to GDP. The economy can only produce so much market capitalization, as he's found. And similarly, credit can only be extended to a level that it can be counted on to be paid back. Both have limits based on the size of the growing economy. We are presently walking headlong into a recession with a tapped-out consumer, corporate zombies, and tightening financial lending standards. Where can the required increasing lending and borrowing come from? The simple fact is that banks and lending institutions are out of additional, new, viable lenders. They have stuffed credit wherever they could for over a decade and now face potential loan losses, defaults, delinquencies, and foreclosures if, and maybe we should just say, when the business cycle turns down. Lending institutions would be expected to and are already reacting and planning accordingly. The total debt of all sectors of the U.S. economy combined totals approximately $88 trillion. Total debt to GDP now stands at 384%. From 1980 to 2008, credit growth drove economic growth. After 2008, the Fed used quantitative easing to push up asset prices in order to create a wealth effect that would supplement credit growth and make the economy grow. This was all part of Fed Bernanke's enrich thy neighbor doctrine. It worked. Unfortunately, but expectantly, it has now come time to pay the proverbial piper. We appear to be out of monetary and financial gimmicks and new sources of credit and debt creation. More liquidity is no longer the answer. We can expect to see a rather significant reversal in the wealth effect unless the powers to be can pull yet another rabbit out of the hat. With the Federal Reserve increasing rates and the 10-year U.S. Treasury note already exploding higher to approximately 2.8% as we talk, it is only a matter of time before something breaks somewhere. Too many players are just too far out in front of their skis and will get caught and can be expected to take others with them. This historically happens every time the Federal Reserve starts raising rates. The contagion this time, because of the levels we've taken credit and debt to, has the potential to make such an event something which we have never seen before. We have a whole newly minted ETF industry over the last decade, which has never been properly tested when holders start hitting their computer sell buttons all at the same time. There will be a shortage of liquidity in a heartbeat. My concern additionally is that during slowing economic conditions, we historically see price earnings or PE ratios contract. This is particularly so when inflation becomes elevated. We currently have PE ratios at historic levels, with the market indexes dependent on 10 large players with themselves having astronomical PE ratios. Scan the level of PE ratios shown here and appreciate that during a similar time in the 1970s, we saw PE ratios drop from 15 to 8 or approximately half. What is to say this doesn't occur again, or even that PE ratios go back to those 1970 highs? Market euphoria disappears, as I said, in a heartbeat once it starts to change. As big a concern as the coming U.S. recession may be, and the fact it could be a global recession, I am more concerned that it will usher in an era of stagflation. Stagflation may, in fact, soon be felt throughout the developed economies. There is little doubt a recession is on the horizon, but the question of an era of stagflation is not to many, at least yet. To me, what is key is to understand that today a potential stagflation problem is much bigger and much more intractable than most yet fully realize. The way to visualize what is occurring is to think of stagflation as a potential black hole. It is easy to unwittingly and unsuspectingly get into it, but extremely, if not impossible, to get out of once trapped in it. The secret is to avoid it with sound economic policies before you reach what is referred to as the event horizon. Many knowledgeable money managers perceive we are potentially entering such a situation. The reaction by central bankers and those in control of monetary policy is to apply traditional Keynesian thinking to the problem. But in this case, it won't work. What must be done to control inflation crushes growth. What must be done to foster growth inflames inflation. It is the proverbial catch-22. The solution, therefore, is you must identify it early and act aggressively. The hidden problem is that the distortions and reporting games we've been playing for a very long time have let us get much too deep in the black hole and more than we understand because our measures have failed to alert us of the reality of the situation. The political kick the can down the road policy approaches we're accustomed to have only fostered tweaking the warning measures to buy time and make it someone else's problem who will be in power at that point. Let me be specific. Inflation through statistical distortion such as hedonics, substitution, imputation, and others which I have previously chronicled have distorted inflation as measured by the CPI to such a degree that inflation break-even, and real rates are ineffective measures now. I most recently laid out how the new world of inflation swaps has exploded in an attempt to protect the more sophisticated institutional investors from these mirrors and mirages. Economic growth is also seriously distorted by an obsolete formula that is based on sound money and adopted during an era of the gold standard and fails miserably to adequately describe real growth in an era of massive government debt, transfer payments to consumers, and debt-financed consumption, now being nearly 70% of the economy. The creators of this simple formula never imagined an economy like the one we operate in today. Our 2017 thesis paper entitled The Illusion of Growth lays out the indisputable reality of this fact in its 111 pages of detailed analysis. The central problem and differences with what occurred in the 1970s is important to understand. We not only have an order of magnitude worse black hole problem, but our tools are dull and our thinking seriously obsolete. Our politically polarized governance is also a big problem, but which I'll leave for another day. The simple truth and reality is that the U.S. is highly likely to be well below the event horizon. I have unfortunately presented a pretty bad overall story here so far. I'm sorry to be so negative, but the facts are what they are, the facts. I have learned over the years, however, it is never as good as I hope, but never as bad as I expect. We tried to lay out the good news in my recent video entitled The Dam is Broken with Charles U. Smith. The bad news is fundamentally about the imbalances that must be corrected before we launch ourselves into a new era of prosperity. The good news is they will herald new and required changes for a more dynamic and productive future. The changes can be expected to be centered on shifts in financial rebalancing between productive countries and those in debt, unproductive, and countries like ourselves consuming more than we produce. Charles's theory of degrowth is likely to occur, and hopefully will occur. Reshoring, definancialization, and deglobalization, reductions in various degree, can be fully expected. Yes, there will be pain as we experience the items as shown here that are likely to occur. However, there are going to be investment opportunities for those that are prepared to an extent we have never seen before. This is what happens when things change. You may have heard that the Chinese word for crisis can be represented as both danger and opportunity. President John F. Kennedy once inspired America with this quote on that. And I quote, "The Chinese use two brush strokes to write the word crisis. One brush stroke stands for danger, the other opportunity." End of quote. So let's all just grasp the opportunity in front of us. As I always remind you in these videos, remember, politicians and central banks will print the money to solve any and all problems until such time as no one will actually take the money or it is of no value. That day is still in the future, so take advantage of the opportunities as they currently exist. Investing is always easier when you know with relative certainty how the powers to be will react. Your chances of success go up dramatically. While the powers to be are now effectively trapped by policies of fiat currencies, unsound money, political polarization, and global policy paralysis. I'd like to take a moment as a reminder, do not trade from any of these slides. They're for educational and discussion purposes only. As negative as these comments often are, there has actually seldom been a better time for investing. However, it requires careful analysis and not following what has been traditionally the true and tried approaches. Do your reading and make sure you have a knowledgeable and well-informed financial advisor. So until we talk again, may 2022 turn out to be an outstanding investment year for you and your family. And I sincerely thank you for listening.